love for accounting.
In today's video, we will talk about the accounting cycle. Let's dive right in. From our previous video, lesson 005, we have learned about the trial balance. This is one of the steps in the accounting cycle. We will now look at the other steps in this cycle. The accounting cycle shows the step of collecting, organizing, and reporting of accounting information in an accounting period. People have different views about the number of steps in the accounting cycle. Some say 5, 6, or even 7 steps, which is indeed just the same. Personally, I prefer to use the 5-step approach. Step 1. Identifying transactions. In accounting, we can only record transactions for proper reasons. These reasons should be supported by evidence. For example, if you purchase a motor vehicle, the supplier will provide you with an invoice. This transaction is recorded according to the details listed in the invoice. When you later make the payment for the motor vehicle, the invoice will be used to process the check, and the check becomes the evidence of the payment for recording. Step 2. Entering transactions into the books of original entry. Explained by its name, the books of original entry are where different transactions are first recorded according to their nature. For example, credit purchases are recorded in the Purchases Journal, which is also called the Purchases Daybook. Cash payment for rent is recorded in the Cash Book. We will look into these books of original entry in our next lesson. Step 3. Posting to ledger accounts. There are 3 types of ledger: trade receivables ledger for credit customers, trade payables ledger for credit suppliers, and general ledger for other items. While the books of original entry record transactions first, details of these transactions are to be posted to corresponding ledger accounts, completing the double entry requirement. For example, the total purchases for the month will be posted from the Purchases Journal to the Purchases account, while each purchase will be posted to the respective supplier's account. Step 4. Preparing the trial balance. We already know that the trial balance helps us identify errors by comparing total debits and credits. Year-end adjustment, like accruals, prepayments, and non-current asset depreciation, will also be made in this step. Sometimes, a post-adjustment trial balance may also be prepared to facilitate smooth advancement to the next step. Step 5. Preparing the financial statements. As the final product of accounting, a full set of financial statements include a statement of profit or loss and other comprehensive income, a statement of financial position, a statement of changes in equity, a statement of cash flows, and explanatory notes. Each component has its own function and importance. As a whole, the financial statements provide useful information about the entity for others to make decisions. We call it the accounting cycle because after preparing the financial statements, all accounts will be closed to get ready for the next accounting period. We then restart from step 1 through step 5 again. Next time, we will explain more about the 7 books of original entry.
I love accounting.